Hi there. Welcome to another episode of Simple Money. This is David Thompson. I'm John Thompson.
It's going.
And we get together occasionally to talk about different perspectives on money, a perspective of someone a little older, myself, and a perspective of someone a little younger, my son David. So, Dave, what are we talking about today?
Today we're talking about some debt and just kind of what is debt, various forms of debt, and kind of a newer phenomenon that we're seeing, buy now, pay later, that is creeping into our daily lives. So that's what we're talking about today.
Yeah, it's debt gets in the way of many people achieving their financial goals. There are good kinds of debt, and then there are not good kinds of debt. A good kind of debt would be anything that contributes to you building assets and those sorts of things. A home mortgage would be an example of good debt. Student loan debt can be mixed, right? So that might be considered good debt because it's maybe an investment in your future and future earning power and things like that. But the proliferation of student loans has gotten pretty significant, and the cost of education has increased pretty significantly. So the ROI, the return on investment, is maybe not what it once was, but that's okay. That could be an example of good debt. And Dave, what's bad debt?
Bad debt. So consumer debt, things like credit card debt or sometimes buy now, pay later can be bad debt. High interest loans, personal loans, if you can avoid them, those are probably various forms of bad debt. They're higher interest rates. Generally speaking, they're not the greatest of terms, and they're hard to pay off quickly if you don't have a quick exit strategy out of them. So a couple of bad debt there, and yeah, those are oftentimes what people turn to in times of need, and oftentimes that compounds in a bad way, in a negative way, and then it affects them in the future for their daily life, and they feel like they're climbing out of a 100-foot well, and they can't get out of that because they've taken on this various forms of consumer debt that's hard to get out of.
One of you mentioned the buy now pay later. I don't know that people even think of those as debt, right?
Mm-hmm.
And so I think it's pretty obvious that if you use a credit card to buy something and then you can't pay back that same month, that now you're in debt. Like I say in some of our classes, credit cards are a convenience for people that have money. They're not an antidote for people that don't have money. In any case, so going back to this buy now, pay later thing phenomenon, we see it across many different consumer platforms, right? It's built in right
Mm-hmm.
now to your checkout counter. And, I don't know that all the names of the companies, but I started noticing it 12, 18, 24 months ago. Maybe you noticed it earlier.
Yeah.
So from what I understand, and correct me if I'm wrong, because you may have a little bit more familiarity with it. So it sounds like you can choose that. So instead of choosing your credit card or a debit or a bank account or PayPal or whatever else you might have an option for, you can choose this buy now, pay later, and essentially takes whatever the expense is, divides it by some number of months, and let's just call it 6 months to keep it simple. And
Mm-hmm.
if it's a $500 expense, it then divides that expense over that 6 months and then adds an expense to it, a fee to it, in order to have the convenience of spreading that over time. My belief is that I don't think a lot of consumers, I was about to say younger consumers, but I think it might be across all consumers, don't
Mm-hmm.
really understand that that's a very high cost of debt. They don't really get it. So is that kind of the way it works?
Yeah, exactly. It's my understanding of how it works, and it's built into everything online when you're checking out. I mean, most of my shopping is done online, right? So every time I go to check out, there's a little option. Oh, you could pay it over, 4 installments, 6 installments, whatever it might be. Sometimes there's the option of truly, the interest-free installment,
Mm.
but that's usually a shorter one, which is interesting. Um, but yeah, one I saw the other day, it was like I was checking out, something was like $80, and it had, I think it was 6 months of smaller payments, and you had to get down to the fine print to read what actually the interest rate was and what they were charging. But the interest rate was like 16 or 18%, and it
Wow.
didn't feel like much because the four payments
So small. Yeah.
were so small, and so it was only adding a couple bucks to the total $80 price. But you're still paying a high interest rate on that. If you do that across a couple of things that you're buying throughout the month, all of a sudden it can quickly get out of hand.
Yeah. And I think that part of the maybe longer term issue is the psychology behind it, because if people get used to buying that way, so yeah, like you said, $80 for not a big deal. Maybe you end up
Hmm.
costing yourself $6 or $8 or $10 in expense or interest, if we want to call it that, which you may not think is a big number, but that's 16-18%. But then you get used to doing it, right? So now it becomes a habit. It's an ingrained in your way of doing things, and all of a sudden you buy $1,000 TV or whatever it might be, and it's paid over that same time frame, and now all of a sudden you're spending $200 or $300 in interest over time. So that's kind of a bummer. Um, so why don't we talk then a little bit about? So anyway, so sorry, let me just go back on that. So the psychology, and I think the advice we would give people: number one, avoid the buy now pay later if you can. I mean, it used to be called layaway. I mean, for those of you that
Yeah.
are older and have, it was called layaway. You could go into you go into your store and you can say, oh, I really want to buy this beautiful suit, and you couldn't afford to buy it, so you put it on layaway, and that still exists in certain markets. But if you notice, it tends to occur in sort of a demographically lower income marketplaces, and so it almost feels predatory
Hmm.
because it's in areas where people can't afford stuff, and so they're giving those kinds of things out there. Anyway, so you don't want to do that. But then, what are the alternatives, David? What then would people do?
Right. Well, if you don't truly have the money, you turn to a credit card or other sort of loan, and that's a problem in itself. You mentioned earlier you don't want to spend money you don't have, so there's a balancing act of what is actually necessary in life, and what do you need and what do you not need, and what's important to you to have that's something that you're surely going to enjoy. I think we spend a lot of money in our lives on stuff that we look back and are like, oh my goodness, that was kind of pointless, or why did I do that? And so there's got to be a priority. And I know for me, I love golf, and people would consider golf super expensive. It's not the cheapest to go play around with 18 holes and hit a bucket of balls every day and whatnot, but that's important in my life, and I'm willing to spend the money on that because I enjoy it and it clears my head, and it's a good form of activity and stress relief for me. But so every person in their life is going to have a priority on what they think is important, and I think we got to take a step back and realize, hey, is this something that I truly want to spend money on? And if it is, then great. If it's not, then maybe we step back and go, okay, this is not for me today, and don't swipe that credit card. We don't need that new pair of shoes if we truly can't afford it or whatever it is. So that's how I kind of view it.
Yeah, no, I think that makes a lot of sense. I don't think that the advice we give our clients today, or that I would give anyone, especially someone sort of starting out in life, I'm not going to say to deprive yourself. I don't think
Hmm.
that's the way it is. But I think, as David mentioned, understanding where a purchase fits in your life and what important it is. There's an exercise we do in a class where we list out the top 10 most expensive things you ever purchased, right? And you leave out a house because that's different. And in some cases, maybe you leave out a car because a car, which could be a whole nother episode. Maybe we'll talk an episode on cars because that's a whole nother thing. But a car is probably essential to get to work, to make money, and those kinds of things. The question more is like, what kind of car does it have to be? That's the different question. But that being said, I'm not telling you to deprive your life. I mean, do the thing. If David enjoys golf, go play golf. But
Hmm.
maybe you don't need the best shoes in town. Those kinds of things.
Yeah,
Um,
like we've mentioned this in the past. There's no really right or wrong. We've talked about this. There's right or left. You have to determine what's important in your life, and focus on those areas. Right. So
yeah,
that's what we kind of think about.
good. So let's say that someone has already kind of gotten into some debt issues, right? They've built up some credit card debt. They've got some buy now, pay later. They have student loans. They have a car loan, maybe, and so forth. And they're just feeling a little bit overwhelmed, right? It's a cash flow crunch, and so forth.
Hmm.
There's lots of people out there on the internet that tell you to have no debt, get rid of your debt, those kinds of things. But it happens. There's emergencies, and people end up in debt for different reasons. What are some of the ways and strategies that Dave, that we would think about to kind of get out of debt and repay debt quickly?
Yeah, exactly. So I mean, the first step is you gotta realize that you're probably spending more money than you're bringing in, right? And so that's a glaring hole, and that's where the debt starts to add up and stack. And then from there, there's a couple strategies that you can implement. One's the debt snowball, and then there's also the debt avalanche. And Both are great methods. And I'm sure there's many more methods, but those are kind of two well-known methods that we kind of talk about and teach about. And so the first one, the debt snowball, is you kind of get out and list all your debts, and you can look at them from lowest payment and lowest balance, total balance, and you basically find a way to any extra cash that you have, any extra money that you're bringing in monthly, you then apply that to the lowest overall balance, right? And so then you're paying off that balance slowly. And then once that balance gets paid off, you take that extra cash flow that you saved and apply it to the next lowest balance. And pretty soon it starts to snowball and you're able to knock out the balances one by one by one by one. And then the debt avalanche is a little different. It's, it focuses on paying off the highest interest debt first.
Okay.
And so that one might, cost you less interest over time because you're hitting the higher interest ones first. But it, psychologically, you feel like you're making more progress maybe with the debt snowball because you knock out that one credit card, then you knock out two credit cards, and then you're building on top of each other. So really, it's there's no right or wrong way there, but they're both just effective ways to get out of debt there.
Yeah, no, that's good. So, okay, so going back to kind of the debt snowball, so I want to make sure that I sort of explain it and understand it. So, if you have, let's say, you have three credit cards, one is $250, one's $2,000, and one's $8,000, and then you have a student loan for $30,000, you would stack all those up, right? You'd say the 250s first, the 2,000, the 5,000 or 8,000. I can't remember what I said now, 8,000, and then the student loan for 30,000, right? And so you start paying, you make the minimum payments on all the other debt except for the 250, right? And then you try and apply all your cash to the 250s to get rid of it, right? And then that one's done. And then whatever payment you were making there, if it was $80, you move that down to the next debt. So that's kind of how it works. And you have like David mentioned, the psychology of a win is you get it paid off. Now, I want to go back to something that we said very quickly, but I want to go back to, and it's realizing that you're in a hole, right? So that, I think, is a blind spot for many people. It's just realizing that they're in a hole. And budgeting sounds like a bad word. To be frank, I don't really budget. I do manage my cash flow, and I watch what's coming in, what's going out, and I have a sense pretty closely of everything that's kind of going on all the time. But I don't track it pennies to pennies. I will say, though, if you think that you might be in a situation, one of the best exercises I ever did was to get a little tiny notebook. It can be an app. There's plenty of apps to track money for you. We're not going to talk about apps because I don't know them all and I wouldn't use them all, but there are plenty of apps out there, and I wouldn't spend money on anything if you don't have to, because you can go old school and literally get a little notebook, and every day you write down what you spent money on. I went to, Panera for lunch. I got a coffee on the way home. I just stopped to pick up laundry detergent, whatever, right? And so every single day you're tracking your expenses, and do that religiously. Everything that you spend money on, and then look back at it in a few weeks or a month, and really see what the deal was, and what was unnecessary expenses, and what didn't bring you any fulfillment. Starbucks has beat up for years. The latte factor everyone's talking about forever and ever is spending $3, $4, $5, $6, $7, $8 on a coffee when you can have coffee at home for pennies. I'm not going to tell you to deny yourself your Starbucks, but if you're in a hole and you're digging, maybe give it up for a while.
Yeah, I think that's really important because me as well, the credit card's so easy to swipe, or we got, online payments, a lot of online shopping, and you just click the button. You don't really realize the money you're spending. So when you actually write it down, it's like hitting your brain like, oh my goodness, I spent a lot of money. And even auto payments, paying or car loan or auto payments for your bills and whatnot, it just kind of goes out and you don't even realize. And then all of a sudden, if you turn back and actually look at your bank statement or your credit card statement, like, oh my goodness, like I spent a lot of money this month and I need to scale it back. And so that's a good practice, because it's really eye opening when you go back and look at it. And if you were to sit there and write it down every time you did spend money, then you're going to maybe think twice about it in the future if you didn't have that fulfillment.
Yeah. Another trick, which I think is getting harder and harder to do, quite frankly, is, using cash to pay for stuff. I realize I rarely have cash these days, right? And I'm sure that most people younger than I am typically don't have cash with them. That being said, I can assure you, if you convert to cash for a month and pay cash for everything, you're going to feel the pain.
Yes.
You feel the pain in a much different way. So
I agree.
Again, if you think you're in trouble, And and again, that realization is quite real. Think about converting to cash for a while. It might be the places probably don't even take cash in some cases, but whatever. And you get the point, right? Increasing the pain will help cement the idea that maybe there's a different way of doing things.
Yeah, exactly. And it's interesting you mentioned the latte factor. I mean, that's kind of a big internet phenomenon. Or I've been seeing things on Twitter or Instagram and whatnot about younger people that the problem's not our $6 or $8 coffee.
Mm.
These days, housing's too expensive or insurance is too expensive or whatever this is. And I think that's true. That yes, those things are expensive, but if we go back and look, and the reason why people like hound the latte factor or don't eat out when you're young and things like that is because it's so important to scrape together what you can when you're young because of compound interest in the future, right? If you're able to scrape together, even if it's $100 a month when you're in your early 20s, that's going to be a meaningful difference when you're, in your 60s, 70s down the road. And so I think that's why it's preached a lot, even though it may seem like a small amount today, it could be quite a large sum in the future. And so I think that's why it's so highly preached and
Yeah.
out there.
No, that's great, David. Thanks for bringing us back to that. Because at the end of the day, if you're sort of talking about doing debt snowball, debt avalanche, and the objective is to get out of debt, at that point, then now you're able to make maybe better financial decisions, and we know the value of compounding interest and saving early and so forth. And maybe David says saving for retirement when you're 60. Maybe that just is so far away it just doesn't even feel relevant to you. But saving for your first home, saving for a family trip or visiting a place you've always felt passionate about going to, those might be worthwhile things to do at the end of the day. And obviously, we believe that owning a home is important. And yes, it's expensive. Insurance is expensive. Everything is expensive. But I got news for you: it's not going to get better. so, so there's no point in making a problem worse by also maybe having poor financial discipline habits in other areas. Because I firmly believe that the future is very bright. There'll be lots of ways for younger people to be able to buy homes and participate, build communities, all the things that I don't think those things will change. It just may be in a different way than it has been for previous generations at the end of the day. So, all right, David, any final words you want to share?
Yeah, I think just be cognizant of the fact that you're spending money and where you're spending your money. A quick tip is that if you don't want to make a big purchase, in my life, let's say that's golf clubs or whatnot, and I'm feeling anxious to go buy a new set of clubs, maybe I wait, a month or two and look back. If I was at the store, wanted to buy the clubs right there, maybe I wait a month, 2 months. And if I still want to buy those clubs, go for it, right? Because that was something that was important. But oftentimes we'll find that it would have been an impulse buy, and 2 months down the road, it wasn't even something we wanted. So quick tip there on maybe not falling into some debt and swiping that credit card so much.
That's right. I think it's a great tip. Impulse buying.
Yep.
So, all right. Thanks very much. And we appreciate you tuning in, and we'll talk to you soon. Have a great day.